What's up, my
Yeah,
man?
that's all good, man. Yeah, I'm in my big rig right now. So,
Yo, Greg.
yeah, so on YouTube, I call myself Willie. Oh, okay, okay, Willie, you're a realtor. So I got to move over right now. Hold on a second, I got to move over. Yeah, somebody needs to get from behind me. So I got to move over.
Here he
Yeah,
is.
so I got the one guy. I don't know, you might have heard of him. Zoom the Thailand. Richie Mack. You ever heard of Richie Mack?
Yeah, I heard of him.
Yeah, yeah, yeah. He has some questions. He has a house in L.A.
Uh-huh.
that he wants to do some work on. So I
Okay.
said maybe personally Heloc could probably work for him. But the whole thing he said he don't have any tax returns. And I looked that up. It said you can do that. You can do a personally. Well, I don't know. Personally, you can do a Heloc without for tax returns. You ever heard about that?
Yeah, I mean, he would need to provide income information at the
Oh,
very
wait a
least.
minute. Backing up. I can't hear you.
If he didn't have tax returns, then they would need about 6 months of like his
Okay.
bank statements.
Hear me now.
Say again?
Yeah, the first link. Can you do a HELOC without tax return? I heard that you can. I don't know if that's true or not. So I'm gonna ask you: can you do a first lien HELOC or I guess or second? I guess with no tax returns.
Yeah, with as I mentioned, with the first, they would need his bank statements if he didn't have
Bank
tax
statement.
returns. So they would
Okay.
need about 6 months of the bank statements.
I'm gonna tell him that. So I just okay. That's one question I had. The other question was
Are you saying
uh
you cool with Zoom the Thailand guy?
yeah, Richie Mack, yeah. Yeah, I'm cool. I'll be on the podcast. I'm about to go to Thailand. I'm leaving on
Okay.
the 12th, man.
So
I'll
you
be
a
there. I'll be
passport
there.
bro. You a passport bro.
Well, I have a passport. I'm a brother, but I don't know about a passport bro stuff. I've been places. I've been to Jamaica. I've been to the Caribbean. I guess
Right,
I'll have to
right,
have a
right.
passport for the Caribbean.
Right.
But yeah, I'm going to Thailand. I ain't call myself a
Okay.
passport, bro. I'm saying I'm a brother with a passport.
I'm a brother with a passport too. I understand, my brother. I understand.
Yeah, I'm a passport bro. That don't sound like I sound. I'm a brother with a passport. But I'm gonna put this on YouTube, man, on my channel, WillieYourRealtor.com.
Okay.
Really your realtor on YouTube. That's gonna put that. Because
Okay.
you recorded, right?
Yeah. I'm gonna send it to you.
Okay. Okay.
Okay.
Well, before you get to, I know you got a lot to tell me. I'm gonna get through my questions before I forget about it. Another
All
question
right.
is it variable or is it fixed when you pay for a HELOC?
Okay, so that will depend on the lender. So you can sometimes set fixed terms for a certain amount of years. So you might be able to say, okay, I want 5 years fixed, or I want 7 years fixed, and then the rest of it would be variable. Yeah.
Oh, okay.
But depending
Right.
on your income, you might be done paying for it by then anyways, right?
Okay. Yeah.
And the other portion of it that I would state is that none of these things are locked in. Like you're not, it's not like, well, a mortgage you can refi, but a
Yeah.
refi doesn't benefit you in a mortgage. A refi actually benefits you in a HELOC. So, like, every 6 months is really viewed as what we would call the shadow period.
Okay.
Right?
Every what?
Every 6 months is what we would call the shadow
Oh.
period, right?
Okay.
And the only reason why
Right.
I call it the shadow period is because for 6 months you can't refi, right?
Ooh, okay.
But
Okay.
but every 6 months you'd be able to. So if you were in the loan for 5 years, you could
Oh,
refi,
okay.
in
So
the
you
middle.
just got to get good terms from the beginning. Get your
Yeah,
terms current.
you can refi,
Figure it out.
then.
All
So
right.
so the reason why I say that is because sometimes people do focus on, oh, it's variable instead of fixed. But the truth
Yeah.
of the matter is if you had a variable interest rate, a lot of people don't think about this. They associate variable all the time with negative.
Yeah.
But interest rates could also drop too.
Oh yeah.
right? So,
Yeah, that's a good thing.
so you could have a variable interest rate and then it could drop as well. And so if you were in a fixed interest rate and then all of a sudden, and right now we know we're in a high interest rate environment. So
Okay,
if
let me back up again. Hold on a second.
go ahead.
I can't hear. Can't hear what I'm backing up.
No problem. No problem. No problem. No problem.
Can't see you guys.
You're good. You're good.
There we go. Okay, yeah.
Right.
Yeah.
So,
I had to back up a little bit. All right.
okay. So as I was mentioning, if you were in a fixed interest rate, but then the interest rate should drop. So, and I'm just saying this because I don't think it's necessarily a good thing at this particular time to be looking for a fixed interest rate. Interest rates are higher than they normally are, right?
Yeah.
They're at an all-time high. So
if you want to get lower, you have to refinance if it goes down lower.
Right. So if I'm a person looking at a HELOC right now from a variable standpoint, there's a chance that this variable rate could drop from where it's at right now to being 3% less next year. Because the interest rates have gone up tremendously over the course of this last year, right?
Yeah, right.
And that's just something to think about as well.
I think they slowed down a little bit right now.
Yeah, they're slowing down a little bit. They're starting to come back. You know, they're starting to normalize back. But I'd rather while it's dropping be in a variable than a fix, if I'm frank with you. Right? You really lock in when you want to go fix, you really lock it in at a low rate and say, okay, this is what I want to pay for this extended period of time because I don't think it's going any lower. Right. I could guess that interest rates will be lower than they are right now. And that's not me being a Nostradamus.
That's possible. Who can't predict it, but depends on the economy, right?
Yeah, it depends on the economy, right? But I could say right now they are high, right? Inflation, all these different things. Once you get through a period of inflation, eventually you're going to see the interest rates lower again. That's just how it goes, right? So that's one thing that I would draw attention to in reference to that. But the first lien HELOC. So the thing about the first lien HELOC that I think really works for especially somebody like yourself, right? If you have a number of different incomes coming in and it's a good deal of money per month, as long as your expenses aren't crazy and you're managing that appropriately, the first lien HELOC would be a better fit. If you don't manage your expenses, that's when the first lien HELOC doesn't work, right? So, for instance, if I got a person and they make $10,000 a month, but they're also spending $9,000, $9,500, or $10,000.
You got $5 left.
This ain't it. Right? I could be very frank. This ain't it. Now, if I have a person, even if they were making $10,000 and maybe they were spending $7,000, which is still a lot. If you don't have a business, spending $7,000 a month on just regular expenditures without your mortgage included is a lot. Right?
Yeah.
So, but that person could still make the HELOC work in a way that they'd be done paying the HELOC off in 7 years.
Yeah, that's what I'm saying. That one bill, that $36,000, I put that in HELOC. That'll free up $1,000 more a month for me. So. Yeah, definitely. So yeah, that'll definitely help your numbers a lot. Because this is all about cash flow. Yeah.
When I tell you that's the most important factor about the HELOC, it is by far the most important factor to the point that interest rate really doesn't matter as much if your cash flow is fantastic, right?
Yeah.
But the HELOC cares more about what you make and what you spend than it cares about the interest rate and how hard that's going to hit you. Because the interest rate is going to drop very quickly with the strategy that we're teaching. We're teaching that you understand the basics of banking, and then you say, okay, what am I making from putting my money in a regular bank?
Yeah,
Right?
nothing.
Nothing. Right? All right. So when I want to use money, how much does it cost for me to gain access to money in a regular bank?
About 26%.
Right.
Or more.
So, and how hard is it for me to gain access to money in a regular bank?
Oh, it's hard. You got applications and credit check and this and that and the other thing.
A lot. You got to go through a lot.
Get some hoops.
Right. You got a lot of hoops. So now you transition that concept and you say, okay, is that a positive relationship or is it a negative relationship? It's really a negative between you and the bank. Yeah. You don't really like the way it feels. You might not.
They like me, but I don't. They like me, but I don't like them.
You don't like them. That's a good way to put it. So I call the regular relationship you have with a bank a parasitic relationship.
Okay.
Right? A parasite, right? Because a parasite
definitely. They eating on me.
Like you don't like it, right? It's feeding off.
Road spray don't work.
Yeah. So now the HELOC, I call that a relationship that is more so symbiotic. Right? And so a symbiotic relationship symbolizes that we both mutually get something out of this. So basically, the bank gets something out of it. They just don't win 100% of the time, right? But you also get something out of it. The bank is only getting that they're charging you interest. So they'll make some money, but they're not making the type of money that they were going to make initially, right?
Yeah.
On the mortgage.
Simple interest, but they don't like to use.
Right. And that's the gist of it.
Yeah.
So now I remember you mentioning as far as the house was concerned, you said, what about value and how much you owe or how much the balance is?
Like I said, 320. That's how much I owe right now.
Okay.
The value is about 480. That's my comps. I'm doing my comps as a realtor. I've been looking at about, I say between 475 and 485. So it's probably right 480. Right there.
Okay. All right. So now, typically, and I don't know. Never mind. So typically, when we talk about that 480. We're usually going for a 90% loan to value. So a lot of times people wonder why, although I can help, attach you with a first lien HELOC or an all-in-one mortgage on an investment property, I'm always going for the residential property. And the reason why I'm going for residential property is because the loan to value is higher, typically, if you can qualify for it. So in essence, if it was an investment property, you're usually looking at 70 to 75%. If it's I
want to deal with that later on.
Yeah. If it's a residential, then you can go for 90%. And I'm going to tell you one thing that kind of flips, one strategy that I always tell people to do is, after they've went ahead and, cleared out another home, you have the ability to say, I always want my loan to values to be technically the residential style. And the way that you can do that is you can just continue taking out debt on your residential house to pay off your real estate. Right?
Okay. Well, if I want to buy some investment property, just use my house and buy that. Then
absolutely. Absolutely. Why would you do that? Well, you think about it. Let's say you wanted to form a mortgage on just a traditional mortgage on another investment property. So you're looking at an investment property. You know that total with the fix and flip and everything, you're probably out $80,000, right? I'm just kind of giving you that idea.
Yeah.
All right. Well, it may take you a year inside of your residential HELOC to pay off $80,000. Well, why is that a big deal? Well, if I'm doing a buy and hold, if I'm doing a fix and flip and whatever, If I'm doing a
Yeah.
fix, I can just bring the money right back to the HELOC, and now I got the profit.
That's what I want to do. I don't want to buy it
Right?
whole. I just want to buy it,
Now-
fix it, and sell it.
Now, if I do, now here's the caveat though. If I do buy and hold on anything, I can pay off the property so much quicker because now the cash flow is coming fully to me, and it's not a fraction of the cash flow. So what I mean by that is one of the biggest mistakes that I find in most real estate investors is that when they have a real estate portfolio, because they come here all the time, I got 20 houses, I got 25 houses, and I can predict how much profit margin they're making off of each house, right? And hopefully they're making about $300 on average per house, right?
Yeah.
So really, it's hustling backwards, if I'm frank with you. And the reason why it's hustling backwards is because of the amount of leverage that is out there is so massive on 20 or 25 houses. And for you to say, okay, well, I'm only going to get $300 a month for an extended period of time on this house. Well, one, how long does it take for that $300 to be worth it to you for the risk you took?
A long time.
A very long time, right?
Yeah,
and the reason why is because of the amortization schedule on those houses that you have set up. Whereas if you were to use your first lien HELOC as a quarterback and say, okay, I might get a mortgage on this house, but I'm going to let the first lien HELOC pay it off. Boom. Well, now I'm charging this person $1,400 to live here. I receive this entire $1,400, and it goes back into the HELOC as cash flow added to my income.
Yeah.
Now that house gets paid off significantly faster. Your house continues to drop significantly. Any debt that you have will continue to drop significantly faster because you've increased your cash flow and because the HELOC is technically a principal priority loan, not a interest priority loan. Now, that's something that kind of gets lost in the shuffle.
Oh, I understand it.
A regular mortgage is a interest priority loan.
Amortization.
Right? A HELOC is a principal priority loan. So when you pay it back, it's very easy to pay it back because it prioritizes principal and then it calculates interest on the back end, right? I like to illustrate the difference on the interest, how they work. If you have interest on a mortgage, it's very akin to having a W-2 job, right?
Okay.
You got a W-2 job, your taxes are predetermined because on your gross, right?
Right.
But when you have a 1099 job, your taxes aren't predetermined, right? That's something that you figure out after you spend all the money that you want to spend on your business and your property. So that's the reason why people can end up not paying taxes, because they can say, okay, well, do I want to pay taxes or do I want to buy this car for my business? Or do I want to get this piece of machinery for my business? I'd rather get...
Which is tax deductible.
Right. I'd rather get this machinery because it's tax deductible and it lowers my burden. That's actually how a HELOC works when it comes to the interest, which is why the interest is not the interest rate is not a bigger factor on a HELOC, simply because it prioritizes principal and not interest. Right. And so the interest payment of the HELOC, usually the way it works is that you have this 31 days, right? And let's say your income comes in. So you make $10,000. The principal drops by $10,000. And then in that day, the interest is calculated off of a number that's $10,000 less, right? For that day. Now you cruise and cruise and cruise, that interest will continue to be calculated off of a number that's $10,000 less. And then your expenses come out Well, now if your expenses are 4,000, now the interest for those days after the expenses came out is calculated on a number that's $6,000 less, right?
Okay.
And now when we get to the end of the month, it grabs all the daily interest calculations and averages it out.
Mhm.
And then that's your interest payment, right?
Okay. So he like you have like a set monthly date to pay, and what's the grace period?
So a HELOC, it's giving you until the 31 days anyways, because that's how it's averaging out your payment, right?
Oh, okay, yeah.
It's going to average out your payment in 31 days, right? So whatever is your start date to 31 days, that's basically what it is, right? But if you're putting income in it, you don't think about what is the day it needs to be paid because your income is counting as a payment.
Oh,
So
yeah.
you don't
Okay.
you no longer think about deadlines of paying your rent. That's gone
Oh,
in first position HELOC.
okay. I didn't think about that. Yeah, that's
That's
cool.
gone. That's gone because now your house is your bank. So whatever goes into the house is counting as a payment. But you just
Oh,
have the ability to take it back out when you need it without having to refi over and over and over again and add extra years and add more
I
interest,
like that. I like that. Yeah,
right? So that's a
yeah.
very big difference for a lot of people. It's like, oh, well, what date does it come out? That's not how you're going to live life. That's how you've been living life.
Yeah.
But that's
I'm
not,
worried about the deadline. I got to pay by the 16th.
yeah, no. That's not the feeling that you get in the first position HELOC, right? So there's a
Oh
day
man.
when it calculates the interest, but your stuff is already paid by your income coming into the account.
Okay, I like that. I like that.
Not sending anything extra, right?
Yeah.
So that's one thing I want to make sure is clear. Now, of course, for some, they've now paid this thing off, or they've gotten so low on it that they don't want to. Well, some don't want to pay it all the way off. You can pay it all the way off as long as you keep the HELOC open. You will not have any problems having paid it all the way off, right?
Yeah.
Now,
I want to keep it on full.
the one thing I'll mention is normally if you're trying to enter into the HELOC again, so if you want to refi again, you want at least $100,000 that needs to be replaced, right?
Mhm.
So now they don't care how that $100,000 is being replaced. It could be you buying an investment property and it rolls your debt back up to 100,000. Okay, now you can refi, right?
Mhm.
It could be you buying an annuity. It could be you buying an insurance policy. It could be whatever. It
Yeah.
could be you having long-term care. It could be whatever. And they'll just go ahead and say, okay, well, there's $100,000 of debt here. Now we can replace it once again with the first position HELOC.
Okay. One question. Now, if I buy an investment property and I sell it for 500,000 and I pay off my 320, I still need to leave some money on the HELOC so it stays open. If I pay it off, then it's closed, right?
No, it's not closed. So
Oh, okay.
there's some companies that have that okay, well, we're just going to close it. But a lot of the companies that I work with now, that's
Mm.
not the situation. A
They want to
lot of
close if I want to close it, right? If I
yeah,
want to.
yeah. So you could have a draw. Let's say if your draw is made out for 10 years, right?
Mm.
So kind of follow this concept. Your draw is made out for 10 years. You set up initially to have the loan to value, but you had 300 or $400,000 of debt that hopped on there immediately, right? You
Okay.
pay off this debt in 4 years or 5 years, right?
Okay.
So when you paid off that debt, you still have an additional 5 or 6 years of draw period. That draw
Okay.
period does not go away because you paid
Okay.
the house off. That's their end of the contract. They have to honor that draw period. Now, if you say, okay, well, I want to refi to gain access to more money, so this is these are the reasons why you would refi in a first lien HELOC. You may refi because you notice there's a house in my neighborhood that just sold for $100,000 more than my house. That would be the perfect time to refi because the value of your house may be higher than it was when you originally refied into the HELOC in the first place, right? And so remember, this is based on the value of your house, not the equity. So you would actually be opening up extra money immediately, right? Just by saying, hey, I want y'all to redo the paperwork. Let's start this over again. You're not adding extra years.
Just extra money.
You're just adding extra space. Right? You're not adding more interest being charged to you. In fact, the interest rate might be lower by then. Who knows?
Right.
But we know that the balance should definitely be lower by whenever that happens. And if the balance is lower, then your payoff is still going to be what it will be.
Okay.
Right? You know, so that's just something, another tidbit to add to that.
Do you have a book? You should have a book on this stuff, man.
I should have a book. No, you know what? I'm not teaching nothing new under the sun. Right?
Oh, it seems like a secret.
Yeah, no, it's.
Am I telling nobody?
No. I'm not teaching nothing new under the sun. It's just education, right? It's just, you know, just actually kind of reading the contracts, dealing with the banks, asking my due diligence questions about their particular products and how they work. And you know, that's how I gained my knowledge. And of course, you know, if you watched the first podcast, you saw that Briscoe was on the first podcast. So Briscoe, he lived it, right? He lived it, and I found out what he was doing. I was like, whoa, that's pretty interesting. How did you do that? And then I realized how powerful of a tool it was. But he learned from, what's the name? Replace Your Mortgage.
Replace Your Mortgage? What's that?
Yeah. He learned from a company called Replace Your Mortgage. And now they're Replace Your University.
You learn basically online. Replace Your University.
Replace Your he took a program. So he took a course that cost him, I want to say it was like $3,500 at that time, right? And he said it was the best $3,500 he ever spent because, you know, he paid off 2 houses in like 2.5 years. So, you know, he definitely got his return of investment back from all the interest losing. So you know, just kind of studying his case, what he did, and then really asking my questions to whatever bank that reached out to me based on the podcast. We've kind of built up quite a bit of relationships with different banks because of this, right? Different loan officers came out of the woodworks and everything. And so you learn more and more about these products every day just from really going and dealing with the people who facilitate the product, you know, who really designed the product, so on and so forth.
Okay.
Yeah.
Damn.
So
now we got to figure out how much I can get, or how does that work?
So in your situation, like I said, you would be looking at a 90%. So I'm going to tell you how it typically opens up. So you got $480,000 as your amount, or that your value is, right? So at $480,000, your 90% mark would be $432,000 as your basically equity that can be used, right? Now once this once this 432 opens up, I always call the first lien HELOC a jealous loan. It can't exist. It will not exist with anything else, right? So the first lien HELOC says, okay, if I'm giving you $432,000 or access to $432,000, we need to get rid of anybody else who you owe, right? The first person who you owe that they're concerned about, obviously, is your mortgage company.
Right.
And so
get rid of those guys. Get rid of them.
You got to get rid of them. So you have $320,000 left on your mortgage, right?
Yeah.
So now, basically, you would have $112,000. That would be your unused equity. So that's what you can tap into and make shake and move around and do what you want to do with it.
Yeah, get rid of some bills.
Yeah. Now that 320 and as you mentioned, getting rid of some bills. So out of that 112, if you wanted to, and this is normally the first step of, well, outside of just opening it, this is one of the first steps that the bank will do is they'll say, okay, is there any other debts that you need to wrap into this? So if it's 30,000 that you need to wrap into it, they'll just say, okay, well, we'll take the 30,000 from the 112, right? And then you'd be left with the remainder, but now you've gotten rid of that debt. They'll write you a check to pay whoever that is, whatever credit.
Yeah, just send it to them.
Or
wire to them.
Right? And they'll go ahead and take care of that, right? So you won't have to deal with that debt anymore. And then in essence, your cash flow jumps back up because now you're not sending a payment there anymore.
Right.
And that's how it works with the first lien HELOC, right? That's kind of one of the first things they'll ask you is, what else is there that you might need to get rid of or gain control of in reference to that.
Yeah, now is that one, the rest, I just want to put some money on some of my credit cards just to pay them down a little bit. Make them only, 1/3 use, so, that way it shoots up your credit score. Might want to knock out 2 of them.
So how much would you say you have in total of the debt, of the credit card?
Oh, no. Then I want to knock out, credit card?
Yeah.
About 3,000 I want to just close out, but I'll say I would like to use maybe half of that 112. Just take care of the stuff.
Okay.
I'd say just half of that and put everything I need down and put some in. Well, I guess I don't need to put it in the bank. It's just gonna be in the HELOC.
Yeah.
But it'll be available.
So you would be able to make that decision once the application is approved and everything. They say, hey, what do you want us to do with the loan to value? Do you want to go ahead and pay off 60-something thousand or 50-something thousand debt?
60,000.
Yeah, and they'll write your checks and go ahead and take care of them. And then after that, now all of your cash flow that you had associated with it will come back to you, right? Yeah. And of course, your credit score will become better because mortgage type debt is treated differently than your
more debt
or consumer debt, right?
Yeah.
So in essence, what I'm saying is, if you were looking for a house and one house cost $60,000 more, that's easier to qualify for than getting a $60,000 line of credit.
Yeah, hell yeah.
Right?
That's what I'm thinking.
Yeah.
So I say maybe a year from now, then I could probably buy and flip and pay it off, because a lot of houses I'll be paying for it gonna be worth a lot more than what I'm spending. So I can take that money, put it back in the HELOC.
Yeah. So with the HELOC, you can almost get rid of the hard money lender, right?
Oh yeah, I don't want that. Yeah, I don't want that at all.
Well, I don't want to say almost. You can get rid of a hard, having to use hard money if your income is right? So now I know you mentioned this.
I don't really live there because you can't own the land. That's my problem with it. If you buy a house, you own the house, but you don't own the land, so I don't like that idea. I'm not cool with that.
Gotcha.
You only go on the land if you marry somebody there. I ain't trying to do that.
Really? Okay.
Yeah. You can own the house, but you can't own land. And if you get married, you only own 49%. Your fee owns 51%.
Really?
But if you get divorced, she owns everything. You just have to walk away, really. Or if you want to stay there, you got to lease it to her, lease it from her. You got to lease it. You got to pay her lease payments if she wants to leave.
So you got to treat them as good as they treat you.
You got to treat them better. It's like California divorce, man.
I'm done. That is too funny. I
Oh
had a feeling
yeah,
you was gonna say that too. I had a feeling you was gonna say that.
yeah. California divorce, man. Don't do it. Shit. I
Ah,
said, my one swell won't commit suicide today. What you doing? Get married? Oh shit. Okay. Good luck to you.
that is too funny. That is too funny. All right. Okay. No problem there. No problem there. So let's take a look at these numbers here. Um, and this is now. Bear in mind, I want to also make sure this is clear. We're borrowing 380 in this example, not 318. So your original amount will come in as lower, but this
Yeah.
380 is focused on getting rid of the rest of your debt, right?
Yeah.
That's
Right.
the important thing to realize here, right?
Right.
So now if we take a look at and if you want, I can just let me take a look at 318. All right, yeah. So for instance, if we were looking at 318 as a digit, you would be paying the house off in 7.33 years, right?
Okay.
Um,
What
and
payment you talking about at that? Look, I can't get the payment. I'm putting money in,
so
so I
we're
can't really
paying,
count
that's what 7,300 going in every month,
it.
right?
Okay.
And your expenses coming out. So
Oh,
$2,000
okay.
expenses coming out, right?
Right.
So now if we jump that up to 380, that number goes to 9.42 years, right? But I'm going to focus on something that's going to be very interesting for you. So in the
What's that?
380 example, the interest paid is $149,773.85. And your mortgage at the 318 example, the
Yeah.
interest paid is $184,969.99. Now the interest rate on them are drastically different. The interest rate on the HELOC is 7.5 in that example, but
Yeah.
the interest rate on your mortgage currently is 3.5. So I think
Yeah.
you're seeing that, this strategy can really help with how to pay this debt off quicker, higher interest rate.
Yeah.
So I'm
Well,
running,
you know about
I'm running numbers on a higher interest rate and on a higher amount of money,
yeah.
and you're still paying it off in almost 20 years faster,
Yeah.
and you're still paying it off um with about, let me see here, with about close to $40,000 less. So about 30.
Damn, I'm paying $40,000 less.
You're still paying $40,000 less to wrap the $60,000 up in the loan,
Uh, okay.
right? So you're paying off more money, you're borrowing more money, you have a higher interest rate, you're still paying it off quicker than if you
Yeah.
borrowed just enough to pay off the 318, right?
Okay.
On your actual mortgage, right? So that's the difference there, right? Now, of course, when income starts coming in, so let me kind of show you what happens. So if you're getting on YouTube and you're starting to do well, because it sounds like you
Yeah.
want to start reaching out on YouTube. So let's just say
Yeah.
YouTube adds another $5,000 to your income for most,
Yeah. Yeah.
right?
I need to post some videos. I know. I'm
Right.
about to do a Thailand video. I'm going to do that on my New West Entertainment TV.
Okay. All right. So I'm gonna show you now. If you were averaging $5,000 more in that example, you'd be paying the house off in 3.67 years, right?
Go ahead then.
and you would only be paying $56,000 towards the interest on there. So I run that scenario for you because what it helps you to wrap around is how important cash flow is.
Yeah,
Right? How important it
that's
is.
why I think about, like I say, buying a house, flip it, put that money back in it.
Yep. Yep.
So that's the main thing. A lot of bad deals out there as far as flipping.
Absolutely.
You gotta do it within 6 months, you know.
Yeah. So, but yeah, that tells the story. Now, the other part that tells the story, and I always like to kind of put some emphasis on 2 points of data, on this scale. So one of the points is how slow the interest payment changes in your mortgage, right? Because that highlights how amortized interest is. So as we look at the first month in your mortgage, so you got 318 as your balance that's left. The first month in the mortgage, we would be looking at 900 or no, yeah, $927.50 that would go towards the interest payment in your mortgage, right? Out of
Yo,
what?
let me add one thing. Also, I'm a realtor, so every now and then when I can find a house to sell or find a buyer or seller, that money's gonna go, in there. But this year, I haven't sold any houses. It's been a bad year, but maybe next year. But even you're talking about, that's gonna help me too.
Absolutely, absolutely. And that's the cool part about the Heloc. It actually cares about how much money you're making. I always tell people a mortgage is a parasite, so it only cares about one thing, itself. It doesn't care about what you actually are doing, and it doesn't reciprocate that energy. A Heloc does. If you get a bonus check, for people who are like, corporate, they get a $20,000 bonus check. Imagine what it feels like to just drop $20,000 down and your principal drop by 20,000.
Yeah.
Right? That's a benefit that those type of people get because, okay, I got income coming from different places. Oh, there's a big deal. Boom. And it hits. And now they're free, right? Or things are going better for them, so to speak, in reference to that. So that's one benefit. But I wanted to focus on this metric here of at the 2-year mark, how much the interest payment has dropped by in your mortgage. So in your mortgage with those metrics, your interest payment has only dropped by $37.63 in the mortgage.
Right.
Now, remember, we are borrowing a higher amount of money on the Heloc, which is the 380. So the interest payment is significantly higher. One, because you're borrowing so much more money. That's number one. And number two, because there is no principal that is defined as a payment in the Heloc. So the principal is just what is left over in your income, right? So let's take a look at what that looks like from a 2-year standpoint of how much the interest dropped by in your case. So interest is $2,375 in this example. And then we subtract the 2-year mark, which is $1,975.34. So in that 2-year span, the 24 months, your interest payment has dropped by $399.66 instead of how it dropped in a mortgage by $39. Right?
Yeah.
So no wonder the Heloc, even though it may start at a higher interest payment, it catches up very quickly with the mortgage because of how much money is going towards the principal and actively lowering how much needs to go towards the interest as well. Right? So for instance, if you're looking at year one, at the end of year one in your mortgage, where you're at right now, you're on track to pay $6,623.65 off in principal. That means that's how much your equity grows by in that given year, right?
Okay.
Now, if we look at what your equity grew by using this strategy by the end of year 12, oh no, year 1, excuse me, year 1, the 12 months, excuse me, you're looking at $36,547.33 of equity gained in that same year versus the $6,623. That's a big difference.
Sound like a winner.
That's a $30,000 difference just in that, right?
Right.
And now, of course, that's including if your son is paying. That's including if your girl is paying. You probably wouldn't even be starting this loan until January, anyways. By the time the paperwork is done and all that kind of stuff, you're probably going to be leaning towards middle December or early January before it opens, anyways, fully.
Okay.
Right, but this is just kind of giving you some ideas. Now, if I were to drop your income back down because you said, hey, I really get about 6,000, and your son is supposed to pay you 6,600. So if I was supposed to drop it down, then you have a 12-year payoff, right?
Okay.
But in that 12-year payoff, even then, your equity that's gained on month 12 is $27,800.96. That's still
6,600. You doing 65, 650 times 12. That what you doing?
Huh?
You doing 650 times 12? You said 6,600.
Yeah. If we added your son's payment, yeah.
Oh, okay.
So yeah, if we added your son's payment in there, then you would be looking at $27,557.81 that's paid off by the end of month 12. That's what the equity gain would be. That is still better than the $6,623.65, right?
Yeah.
Now, here's the kicker of what I just said to you. You might not have even caught it. That's still better, even though I dropped your income drastically and kept the loan rate the same. I dropped your income, in that example, and kept the loan rate the same. The amount that you're borrowing and the interest rate. So this is a much safer loan reference to that. And of course, the only thing that is dangerous about a first lien HELOC is lack of discipline. Right? Because I'm going to be honest with you, when $112,000 opens up, that's going to be a different feeling. That's something that the average person is used to, being able to touch their own money, especially with the higher and higher your money goes. It's going to be unusual for you, but it is something to reference.
I know my main goal will be only use that money if I can find a good deal that I can get the money, fix it, put it back in there within 6 months. But that's be my goal. Anytime I take out something.
I can understand that.
The rest is just paying my bills and buying food.
That's right. Now, I will say one thing that I always do whenever I teach this method, and for you to see it, I always focus on what are your blind spots with this method. So your blind spot is going to be probably estate planning more so than anything. Like making sure that this house falls into the right hands, making sure that you have somebody who you can trust to make certain decisions so that everything continues to go well for you in this experience. So I always tell people,
will or something?
Huh?
So I'm putting a will together or something, or
Wills,
putting it in a
trust,
trust. Yeah.
will, trust, power of attorneys, right?
Okay.
And the reason why is because that is not having a will or a trust is one of the quickest ways to end up in a foreclosure on a home.
Yeah. Yeah, I want to do that.
Right? And I'm talking about from a death perspective, like if something happened to you, yeah, it would be
Yeah.
very messy to try to clean up. All right. So I typically make that kind of like a mandated appointment, like, hey, we need to meet again, but we need to talk about wills, we need to talk about trust, we need to talk about how they work, and even
Yeah.
talk about any business subjects that you may want to talk about in reference to the trust, right? So
Okay.
I bring a team member on who I've hired from my firm, because they've been in this business of estate planning for over 30 years. They're a family business,
Okay.
and they know how to teach you how to protect your assets. So, and Willie, by the way, I know we didn't fully dive into it, but do you have children, Willie?
Yeah, I have 5.
Okay, so you got 5 kids. So
But yeah, all grown though. There's no babies.
no problem. No problem.
Yeah.
Okay.
Well, I got grandkids, great grandkids.
Yeah. Wow. Yeah. So, have you given it thought about, okay, who's going to manage my estate and all those different
Yeah,
things?
yeah, I have. Yeah, I have.
Okay. Wonderful. Wonderful. So what we'll do, and if possible, whoever you're interested in, like your kids or whatnot, that you want to get on a call with us, we can get them
Yeah.
all and just kind of describe these different roles and how they play out um, in regards to making sure that your home is safe. That if something did happen to you, they would be able to refi into the Heloc again, or they'd be able to sell either one that is going to be best for their circumstances. Right. And then the ramifications of doing certain things as well. I think that's really important for people to understand.
Good.
Yeah. So, Willie, do you have any questions for me?
Yeah, I would like all those charts you were showing. Can you send them PDF?
Yeah, so you're going to get as I mentioned, you're going to get a recording of this meeting, and I can share that with you. I'll share a little calculator with you to kind of sort through it. Another thing is I'll drop my link so that if you need to get directly to a loan officer, that you guys, whoever they can get directly into a loan officer if they like after their conversation with me. Now the caveat.
Well, yeah, well, I won't say you have people, so I'm gonna go with your people because the people I know don't know nothing about this. They claim they don't know.
Yeah, I got tons of people, and that's one thing. Although I'm going to give you the link for you to be able to go forward and try to move forward with this process, I always encourage people to book a call. And the reason why I book a call is the bank wants you to have the greatest degree of success. So they don't want you getting into this and it not really being a fit for you. They want it to be a fit, and when it is a fit, it's perfect for the client, right? It's the right thing for them, and it's going to work greatly. If it's not, then they don't want to waste the time of going down that pathway. They don't want to waste the client's time, of going down that pathway. And so, it's always really, really good for me to get a chance to kind of run through a person's numbers and spend time with them, because we have a better understanding of how successful they could be, right, with this strategy. Because a lot of people can be successful with the strategy, but many of them, if they haven't done their due diligence to learn it appropriately, or if they just heard, hey, I could just fill out this for a first lien HELOC, they go into it and not really have any understanding of how it works, what it does, and why it's superior. And so we really want people to understand that this is a lifestyle change, right?
Oh yeah.
This is a lifestyle change. It's not like a regular, like, oh, I changed my diet a little bit. It's a lifestyle change. Most people have never had access to over $100,000 at one time.
Okay. Oh, well, that's one question. If I wanted to buy a flip or a property to fix and flip, how hard is it to get the money to do that? Do I go jump through a lot of hoops to do that?
No, so when you think about the liquidity of this product, think about a credit card.
Yeah.
That's how liquid it is. If you have a limit on a credit card, you can swipe up to that limit all you want to.
Yeah.
And that money is available. In this situation, when you have a limit on the home, so your initial limit is 112,000. If we use 60,000 to take care of that debt, then you're going to have the remainder of it basically as like a credit card, right?
So no one limit.
Yeah. The only difference between it is that it would act like a credit card that also has, basically traditional features on it that can help you to monitor yourself and your usage.
Yeah, but better rate though than 26%.
Oh gosh, way better rate than any credit card. Way better rate than any credit card. It basically flips the credit card standards upside down. So normally if you got a credit card, the good thing about it is the liquidity. So the HELOC is like, hey, I'm liquid. That's a good thing. But the bad thing about the credit card is that normally you have low limits with very high interest. Right? That's easy to qualify for. In this particular situation, when you're in a HELOC, you would have a high limit with low interest rates. Right? I think I speak for everybody that if there was a credit card that just stayed at 7% or 6%, that is a fantastic card.
Yeah, where's that card at?
Right? It does not exist. It does not exist, right?
Okay.
But the HELOC would be the closest thing with a much larger availability on it.
Okay. Well, let's do it, man. You tell me what I need to do first.
Okay. Well, I'm gonna send you an email following this appointment. It'll be this video, but I'm also gonna send you a separate email, and that separate email will be it will be a form that you can fill out to have the bank reach out to you, right?
Okay.
The bank will do the same thing. They'll go over calculations and everything with you because we really don't want you putting yourself in a bad position. We want you to be in a good position where you can win, right? And so that's going to be the main priority anytime you deal with us in reference to it.
Yeah, they've got to set up I guess you got to get the loan out way first before you do the meeting with the trust and all that. Do that.
No, you don't have to. You don't have to get the loan out of the way before you do the meeting with the trust.
Okay.
I think that at either space and time, doing the meeting with the trust is going to be valuable for you because you're going to learn something new, right?
Okay.
You're going to learn the things that probably you never thought of as far as the holes in your financial journey or how bad things could get. If you have money in certain places and then you recognize, hey, that's not really gonna that's not really something that I can use. You find out a lot in the trust process that gives you some clarity about how money works, how your state views the money that you have or the property that you have. and how to make sure that your family receives what's rightfully due to them without adding expense.
Yeah. Okay.
Yeah,
So let's set it up then. We have some maybe like on Monday next week we can set it up for I don't know what day you available next week.
oh, for the estate. Okay. Let me take a look. So I possibly could do that. I would say my
Right, later
time.
in the afternoon.
Yeah, my time frame's on Monday, so I could possibly do it at 3 or 4 p.m. my time, which I believe is 1 o'clock yours.
Well,
Or
yeah, that's 2 o'clock would be better for me.
2
I
o'clock
guess we
yours.
have make sure my son is available. Have one of my
All right,
sons
that's 5 o'clock
available.
time.
We just do
All
a
right,
Zoom on both ends. He probably he'll probably be at home. But we
gotcha.
could get on the Zoom together.
All right, so we'll aim for that 5 o'clock slot then
Yeah.
on Monday the 6th. And this is going to be it's going to be an estate planning appointment.
Okay.
Okay. All right. And so I'll add my estate planning team into that. All right. So I just got that sent off to you.
Okay.
All right.
All right.
Nice.
Thanks for the info.
Oh, no problem, my brother.
I don't have any questions. I just hope I could get it. Just getting qualified probably
Yeah. So qualifying, typically you got the main things that are going to look at are debt to income ratio. They normally like for it to be above 45 or 50%. In reference to your credit score, they normally like it to be a 680 or above.
Sure, well, it seems one said 690 yesterday, 693, but I don't know the exact correct. We'll see.
Yeah. So.
But then if it's not there, I can always get it a second until it goes back up, then switch it over, right?
Yes. So that is a method to go with the second position HELOC until you actually do
So if I have to
credit score up.
Until I get to the score, they won't. Yeah.
Yep, you certainly can do that. You absolutely can do that. We do that sometimes for clients just to meet them in the middle ground and get them to where they need to go. Absolutely.
Yeah, okay.
Absolutely. Yeah. Good question. I appreciate that question. That's a good question. That shows your head is on. You're thinking.
Well, I'm always thinking. But sometimes I heard your podcast with what's his name? Guy.
You mean with
What's that guy's name?
With Jamel?
Yeah, Jamel.
Uh-huh.
Yeah, I heard you say that.
Yeah. That's a good introductory way. Is going ahead and cleaning up your debt. As you moved your debt over, you've now given it a better, really kind of given it a better, what do you call it?
Credit score?
Yeah, you've given it a better interest rate and a credit score that's better. Simply because when you move the debt over into one place, you can kind of change what the utilization is on all those other cards.
Yeah.
Right, and so that helps it to rise back up as well. As long as you're paying down, that's going to help it rise back up as well.
Yeah.
Yeah.
Okay, well, that's all I got for now, man. Thanks for talking to me. Learned a lot of stuff. I got some stuff. Okay, I think I asked all the questions. Don't worry about it. The one guy said, can you use Okay, he needs a bank statement. You don't have tax returns. The other guy's in the best. Oh, one guy want to know. Yeah, if I don't have a house, I'm looking for a house, and I want to use a HELOC to buy a house. Is that possible?
Okay.
First lien HELOC.
So it would depend on how much capital he has to start that. So
He said to have money down.
Yeah, it would be a high money down, because what you're gonna do is, if you're gonna enter the first lien HELOC purchase, you got to enter with at least 10%.
10%.
Right, and so
that's not bad.
Yeah, so depending on the house, but you got to think, if it's a $500,000 house, then you got to have 50,000 coming to the table.
Yeah.
Right, which can be difficult. Right. Now there's different means. So there's shortcuts to getting 50,000. So let's say you got a client who has, over $100,000 of their 401k. They decide to do a 401k loan for 50,000 to buy their house. That is one of the provisions for a lot of people. So they'd be able to kind of use that to kickstart them being able to get the first lien HELOC.
I know a guy. He has the money, so he could just do it. So
yeah, if he has the money, then it's a no-brainer.
Yeah. Okay.
If he has the money. So technically, if you have the money with this strategy that we're talking about, you can not only purchase a house, you can build a house.
Oh yeah. You come with build a house.
Yeah, you can start a project. You can construct a house if you come to the table with 10%. Right.
Okay, that's another thing I want to do. I would like to open up a comedy club, but I want to build it because the size I'm looking for is not available. I want to build a comedy club in Victorville. So if I could get some, I guess I'm talking about business credit. Get some business credit, then get a HELOC to do it.
Right.
What I need to build it. That's including the parking lot, the building, the furniture, and everything that goes inside of it.
Yeah.
That's the one thing I want to do. I think that's I'm guessing about 500 to 600,000 right there to do that. I'm just guessing.
So that and that is a means of being able to get into it and start to pay it down a little bit quicker. Of course, I always tell people the hardest part about a building project is you're starting off on something that is high ticket from the start, right?
Yeah.
So if it's 500,000 or 600,000, you're coming to the table with 50,000, but also the interest payment is going to be significantly higher. So your income has to suggest that it's feasible for you to pull this off, right?
Okay.
And that'll be kind of the main caveat to that.
So I had to do a business plan. When it comes to business, I need to do a business plan so I can show how much this business is going to make and how much time before we start making that money.
Right. Yeah.
Okay, because I want to do that. But I can do that. I can do that separately from my residential. Because they have a business class HELOC.
Yeah, so a business can own a HELOC as well.
Yeah. Should we call something else or what?
You said, do we call it something else?
Yeah.
No. HELOC. Yeah, it's a first position HELOC. It doesn't change the name of it. A lot of times when it comes to investment properties, a person might use an all-in-one mortgage because a first position HELOC hasn't been created that covers investment properties right now.
Okay, well, we'll have to invent it, man. Let's be the black inventors. Why wait?
They're currently actually talking about it. Like first lien HELOC is actually they've been on the fence for years, but they're starting to move towards it because so many people who own the first position HELOC on their own home they have so much money that, you know, they're able to create these other avenues to make more and more money for themselves. And they're putting more pressure on, hey man, I wish I could do one of these as an investment property. Right? But typically the investment properties that you will see are usually I think 70 to 75%. If you were in a residential and you had, some people house hack as well. So if you were in a residential and you had multi-units, so let's say you had a quadplex, but you lived in a quadplex, right?
Yeah.
So normally that loan to value is about 80%.
Yeah.
But
I don't want to do that. That's low money.
Well, no, I don't want to do that. I would say it this way. That's not necessarily bad, because think about it like this. If I was in a Heloc and I had a quadplex that we're dealing with, and I'm charging 3 other people rent, then the amount of cash flow that's going through that Heloc is going to be massive. Because I'm also adding my own income through it, but I've also got rid of the expense of the mortgage anyways, because I wasn't going to pay anything to live in my own duplex.
It sounds good, but my thing is, with a comedy club, you're gonna make a lot more money. You know, then you can use supplies, replace supplies, all that stuff. You know.
You definitely should make a lot more money, and you should be able to write off things a lot better. But of course, the expense is going to be where you're going to get hit with the comedy club is going to be the expense. So you just got to make sure your numbers look right as far as the comp is concerned. Because if you want to have a nice comedy club, you probably want to have a bar in it.
Yeah.
You know, you want people.
Liquor license.
You want people to be able to sip. I don't know. You might want people to be able to eat. Who knows?
Yeah.
Oh, that's food too.
Yeah, it costs. Yeah, but it'll make money. It'll pay for itself.
Yeah, it'll make money.
I get those big stars coming there. I get one at least 300 to 500 seats, and get the big stars in there. You know, that's how you do it. You know.
Yeah.
That's what I like to do. That's like, you know, after I get this first thing out the way, then figure that out. How I'm gonna do that? Well, that's probably I'm gonna start my business credit to do that though. I'm gonna join with Don's and Bradstreet and get the numbers and shit together.
Yeah.
So that's a plan I got.
Yeah, that's definitely gonna be important. The Don's and Bradstreet, definitely.
So, all right. Well, let's get in here, man. I got to concentrate on this road. A little bit of traffic.
I went to the crash.
yeah, man. That's why it was bad when it's traffic. The people stop suddenly or they jump in front of you.
Right. And I've been behind one of those things. I used to have my Class A license.
Oh, okay. So you know what I'm talking about.
I know exactly what you're talking about, and I found out I couldn't do it because of that. I was like, boy, my nerves was shot to the world, man. I'm trying to tell you.
You gotta have some nerves in this business. Yeah. You got
nerves for that, man.
You can't have no road rage because you be fighting every day.
Nope. They'll pop right in front of you with no remorse.
They don't care. They give you the finger if you show them something. Like you pissed off. Hey, take this finger.
Take this finger?
Yeah, take this finger, man. Hey, have a nice day.
You ain't lying.
Yeah, one finger salute.
You ain't lying.
Hell yeah, man.
All right, well, I'm going to go ahead and let you go and get this to you. All right?
All right, have a good day.
All right, man, you too.
Later.